Today in this video we are going to discuss on liquidity ratios, and liquidity ratios are also known as short-term solvency ratios. So first we will discuss that what is the purpose of these liquidity ratios, why we compute these liquidity ratios. So the purpose behind computing these liquidity ratios is just to determine the ability of a business to meet its current liabilities when they are due for the payment. So this is the objective of liquidity ratios. And to compute the liquidity of a business, we take these two ratios. We consider these two ratios, current ratio and the next one is quick ratio. So current ratio is also known as 2:1 ratio. And the formula to compute current ratio is current assets upon current liabilities. And the formula to compute quick ratio is quick assets upon current liabilities. So before we compute these ratios, first let's understand what all comes in the current assets and what all comes in the current liabilities. So in current assets, basically we include these assets: cash, bank balance, debtors, accrued income, prepaid expenses, inventories, short-term investments, or we can say marketable securities. But here we need to pay attention that while computing current ratio or quick ratio, we will not consider loose tools, though loose tools are the part of inventories. But while computing both these ratios, loose tools we will exclude. Now let's see what all comes in current liabilities: creditors, bank overdraft, short-term loan, short-term provisions, and these are the example of short-term provisions: provision for tax, proposed dividend. And after short-term provisions, we also consider unclaimed dividend, unearned income, and outstanding expenses. So these are the items of current liabilities.